The US continues to be the largest beneficiary of our capital. We see a lot of innovation happening. AI is an important theme, not just in the Magnificent Five that have sort of caught the eye of most investors, but we're trying to look at adopters, particularly amongst traditional industries, who can drive significant increases in productivity using AI. So those are areas we're looking at. And if you look at the US market, overall it looks expensive. But if you look at the S&P equal weight, it's trading at 16 times earnings, below its long-term average. So there are opportunities, particularly in traditional industries, you can find if you believe that there's going to be a significant shift, and AI could be a value driver for some of them. India, another market we're very interested in. We have been steadily increasing our exposure out there. We continue to see opportunities around financial services, around consumer, around healthcare, the startup ecosystem, logistics, so across a broad variety of areas. Japan is beginning to look interesting. We've not traditionally had much of an exposure there, but with everything that's happening out there, we see structural changes and are spending more time there. And Europe, we're going through a cyclical recovery coming out of a mild recession at the end of last year. We do see rate cuts, the second derivative of credit improving. All of that is going to be positive for growth, and particularly as we move into 2025. So there are opportunities there. But having said that, in Europe, our focus is more on companies that are headquartered in Europe but are global. So less dependent on the domestic market in Europe, but more on global markets.
What do you see are the major risk factors? Is it elections, what we're seeing in terms of the US elections coming up, or is it still the last mile when it comes to inflation for a lot of the developed economies?
So I think most of the developed economies, there's general consensus that we're not headed towards a recession any longer. There's also a general agreement that we're going to see inflation's coming down, and that we will basically see, therefore, rates declining in these markets. At the minimum, the risk that we were concerned about a couple of months ago, that the next move of the Fed could possibly be up, that has largely gone away. So in that sense, things look good. The near-term challenges are one around valuations and high earnings expectations. Because with inflation slowing down, we also are seeing some slowdown in growth in the US. Not into a recession, but what we call a soft landing. But now earnings expectations for this quarter are for 9% earnings growth compared to first quarter where the expectations were 3% and they delivered 6%. So the bar is getting higher. For 2025, earnings upgrades have already happened, and people are projecting a 15% growth in earnings in 25 on top of a 10% earnings growth in 24. So the scope for disappointments is there. That could lead to short-term pullbacks. But I don't think there's anything structural. I think those pullbacks would be an opportunity to buy. Not very different from last year, where the first half of the year saw the S&P run 17%. This first half, it was 15, 16%. And then in August, September, you saw almost a 10% pullback last year in the US. Will that happen? I don't know. It could happen. But like I said, I don't think it's structural. I think it's just some companies running ahead of themselves in valuation, and that could cause a pullback, but recovery after that.
But it is sounding like, versus what you were talking about last year, at the same time last year, that the global outlook is looking more positive.
It is.
I wanted to also ask you just about the investment strategy in general, because, again, same time last year, we had, of course, what happened with the FTX. It was described as that you would take a very cautious approach when it comes to investments going forward. Is that still the view now?
I think the cautious approach last year more generally was around our investment stance in the context of an expected recession that people saw, particularly after Silicon Valley Bank last year. With respect to the early stage investments like FTX, we've always had a very calibrated approach in the sense that we invested in a lot of companies with the idea that it's diversified, recognizing that some of them will not play out. So we continue to have that approach where we limit our exposure to early stage companies to 6% of our portfolio. Half of that is in venture capital funds, which by definition is very diversified. And the other half, 3% of the portfolio, is direct investments in private early stage companies. So we keep to that limit, and it continues to be diversified over about 200 companies. So yes, that's the approach we've been taking and will continue to take going forward.